LUNR, after its massive 37% rally, and it asks the big question: is the current price a real entry point or just a technical trap?
I agree, and it's a great question. What stands out right away is just how well the report lays out the catalyst stack. I mean, it really was a perfect storm of drivers.
Yeah, it synthesizes it so clearly.
It does. You've got the key bank initiation, the big government policy shift on lunar infrastructure, and that $8.2 million Air Force contract for nuclear power.
And it does a good job calming those space sack jitters, too.
Absolutely. By pointing to the $622 million in cash and that, nearly $1 billion backlog, it built a solid foundation. But to really get to those higher price targets, the analysis has to go deeper than just listing what happened.
Okay, so the foundation is there, the rally is explained, and the goal is clearly that $20 to $25 range.
So to maximize the report's impact, the analysis needs to pivot from aggregating known catalysts to establishing a more distinct and proprietary fundamental investment thesis.
Right, so the weakness here is that it's leaning a little too heavily on what's already out there, like the Wall Street high target of $20 or the IM-3 mission.
Exactly. It suggests an internal target of $25 for 2026, which is great, but it doesn't fully articulate the unique moat that justifies valuing LUNR so far above what everyone else thinks.
It doesn't answer the why. Why is LUNR fundamentally different, and why does it deserve that premium?
That's the key question. The analysis needs to show that $25 is the logical outcome of these catalysts working together, not just an exciting number pulled from the air.
Okay, so a suggestion for improvement?
The analysis should weave those three big catalysts, the LTV frontrunner status, that White House order, and the move into defense with the nuclear play, into one single cohesive story.
A story that explains LUNR's long-term competitive advantage?
It has to show how these things create a barrier that competitors just can't easily get over.
Let's get specific. That $8.2 million defense contract, for instance. It's pretty small compared to a $1 billion backlog. So how does the report make the case that it's a game changer?
It needs to demonstrate a compounding network effect. Use the details on the LTV award and the new government policy to show how winning that contract makes LUNR the default provider for all the next lunar infrastructure contracts.
Ah, I see. So the moat isn't just the contract itself? It's becoming the go-to link between government policy and actually getting things done on the moon?
Precisely. And then it needs to elaborate on the scalability of that Air Force nuclear contract. Is it just a one-off diversification? Because if it is, it's not that relevant to a $25 valuation.
But if it opens up a whole new revenue stream?
If it opens a whole new high-margin defense segment that fundamentally changes how you value the company compared to, say, other pure-play lander firms, then the analysis has to make that really explicit.
And that all has to lead back to justifying that non-consensus target.
Yes. Finally, it has to explicitly model how these diversified revenue streams, defense, infrastructure, NASA, all add up mathematically to that $25 price point, show the revenue mix, the margin expansion from defense, and the growth rate. Prove the path from $14.94 to $25.
Okay, that definitely adds the necessary depth to the bull case. But if the whole argument hinges on their ability to execute, we have to talk about the risks. The current bear case, it feels a little light in comparison.
It's not enough for this kind of strategic analysis. The current presentation of counterarguments is heavily weighted towards short-term technical risk, and it would be so much stronger if it introduced fundamental challenges to those core growth drivers.
So the problem isn't that there's no risk section, it's that the focus is too narrow. It talks about the stock being overextended, near the top of the Bollinger Bands, and maybe cooling off to 1250 or 13.
Right, that and the binary risk of the IM-3 mission. It just doesn't really challenge the strength of those three big catalysts. If those are real, the risk isn't just a chart pattern, it's about whether they can actually pull it all off.
Exactly.
The suggestion then is to introduce strategic counterpoints, look at execution risk, competitive threats, the sustainability of these new revenue streams. That would give a much more robust risk assessment for a long-term investor.
The report makes a big deal about their cash on hand. That's $622 million, but growing into a $1 billion backlog. That's a massive operational pivot. They become a totally different company.
It is. So, the analysis needs to examine the execution risk of scaling that backlog. The current path-to-backlog ratio looks strong, sure, but what about the operational hurdles, the capital needed to go from small missions to potentially that $4.8 billion near-space network contract?
Is the current liquidity really enough to manage that kind of rapid expansion? Or are they going to have to raise more capital and dilute shareholders down the line?
That's the question. And if they're serious about this defense expansion, you have to challenge their position. I mean, 8 million is a nice start, but they're now playing in a field with giants.
Absolutely. The report needs to challenge the competitive advantage in that new segment. What are the limitations here? How protected are they from a Lockheed Martin or a Northrop Grumman who might decide to undercut them or just buy out a competitor?
Is this a truly proprietary technology, or is it just a first-mover advantage that could get wiped out pretty easily? That has to be addressed.
Which creates a much deeper, more useful risk profile. So instead of just worrying about a delay to IM-3, we should be looking at the systemic risks baked into the catalysts themselves.
That's it, exactly. Instead of just an IM-3 delay, explore the risk that comes from that White House order. What if it pushes the timeline too aggressively? What's the risk of cost overruns or dilution that could strain the company, even with all that cash? Fast growth always comes with friction.
Okay, that gives the risk analysis the weight it needs. So let's turn to the final verdict. The conclusion is pragmatic. Not too late, but don't FOMO at the peak.
And while that's good advice, the final verdict, well, it splits its recommendation between active traders and long-term investors, which risks diluting the report's central strategic conclusion.
So the weakness is structural. It asks one big question, is it too late to buy? But then it gives two different answers. One is about a technical entry around $13.50, and the other is about a fundamental discount at the current price. It feels like it's hedging.
It is. The report needs to assert a single strong thesis, the fundamental case for that $25 target, and then give clear ways to act on that thesis.
Okay, so the suggestion is to restructure the verdict, prioritize the core fundamental argument,
And then frame the technical entry points as specific tactics for maximizing that long-term opportunity.
so the technical levels aren't for a different type of investor. They're tools for the main investor who's trying to get the best entry. How do we make that flow feel unified?
You lead with the fundamental statement, something assertive like, the long-term case built around this growing moat means the current price of $14.94 is still a significant discount, supporting a $20 to $25 target.
Then you integrate the data from the technical summary table right into that advice.
Exactly. You advise long-term investors to use the identified support levels, say 1320 or 1180, or that active entry at 1350, to build a disciplined position over time. Now, those technical levels are part of the strategic plan.
That creates a much more powerful, unified recommendation. And what about the warning against FOMO?
That needs to be explicitly linked to the technical barriers. Ensure the Don't FOMO warning is tied logically to the immediate resistance levels the table identifies at 1505 and that psychological $18 level.
So you clearly show the immediate risk, but it's all in service of protecting the long-term position. The technicals serve the fundamentals.
Precisely. It protects the integrity of the whole thesis.
This has been incredibly helpful.